You may have noticed that I'm back in my office for this video, and that's because last week I had some friendly commenters on YouTube who were like, the new format of your videos, fallopian, sucks. And so I kind of try and make, the fans of K4 happy, so I decided to come back into my office and do this week's video. And this week I'm going to talk about a really easy concept, but it's also absolutely very important, and that is real rate of return. And all real rate of return is keeping inflation in mind when you look at your investment returns over time. So the first thing to really think about is inflation. What is inflation? And basically all inflation is things cost more tomorrow than they do today, or if I buy something today, it costs more now than it used to back in the day. And we've all had this conversation with our grandpa, where our grandpa was like, back in my day, I could go to a movie, buy a bag of flour and a stick of margarine or butter for 2 pence and a buffalo nickel. And I would always have two questions for my grandpa. I'd say, what the hell is 2 pence and a buffalo nickel? And why are you buying a bag of flour and a stick of butter to go to the movies? What the hell's going on in there? So anyways, I'm going to kind of explain it using a blog I did 2 weeks ago and a video I did last week, and we're going to use those as a good example. So basically a really easy way to come close to figuring out the number is saying, what was your return minus inflation? And that's close to what your real rate of return was, but that math isn't perfect. And you don't know what inflation is going to be, but over the last 19 years, the average inflation rate in Canada has been 1.9%. So for today's example, I'm just going to pretend it's 2 so that our math is easier. It's usually what I use in my projections of financial planning. So last week I talked about the smart savings account at Wealthsimple that generates 1.7% interest every single year. But what you need to realize is that 1.7% is always going to be taxed because it's not in an RSP or a TFSA. So after tax, if your marginal tax rate is 40%, you're making 1.02%. So you are actually losing money if inflation is over 1.02%, which is absolutely ridiculous to think about, but you are losing money, you're losing purchasing power. That's why it infuriates me to see people holding huge lumps of sum of cash in their checking account doing absolutely nothing, because 5 years from now they're going to be able to buy a lot less with that money than they can today. And 2 weeks ago I did a blog and I talked about the return assumptions that we're supposed to use for balanced portfolios. And if I look at the average return assumption that you're supposed to use for every single major bank and financial institution, it was 3.37%. So let's look at the real math on that, pretending that inflation is 2%. And this is the math. It is 1 plus the rate of return you got divided by 1 plus inflation minus 1. So if you do that math, you get a rate of return expected after inflation of 1.34%. which really isn't very good. That is why it's very important to do a bunch of things, and 2 things are of real importance. 1, don't leave cash doing nothing. Let your money work for you. And 2, especially if you have a really long time horizon, it's a good idea to start teaching yourself about the market and learning to be able to invest a little bit more aggressively, so hopefully you can beat inflation quite a bit more than just 1.34% over the long term. So please subscribe to the channel, and thank you very much.